Hello everyone and welcome to today's Morning Report. Charles Praises on Friday the 16th of September with me, which is Pro Market Analyst at Handtech Markets. We've got a corrective open actually on the European markets. Basically the markets are looking fairly cautious, I think. There's a general sort of risk-off sentiment that is across markets today. You've got sort of the dollar outperforming, you've got the yen outperforming the dollar, and also gold and silver holding up, oil lower. These are all sort of examples of ways of showing the market's risk appetite, and I think that certainly would suggest that risk appetite is fairly low, and markets are just increasingly looking towards the Fed, I think, on next Wednesday. And to be honest, there's an element of consolidation across forex majors anyway, but certainly at the moment the dollar's slightly stronger. It's interesting that we had a continuation of the weak data out of the States yesterday, and that certainly pulled the 2-year Treasury yield lower, but also had a little bit of an impact on the 10-year. Now let me show you the 2s10 spread has broken out in recent last week or so to levels of seen not since that Brexit decision on the 23rd of June. So real steepening of the US yield curve there, but certainly what we have seen is a move whereby the 2-year is depressed because the market is not anticipating a Fed rate hike in next week, but also the 10-year has pushed out as well, and there are several reasons behind that, but some of which are due to the fact that there's a general feeling of steepening yield curves as certainly the ECB failed to deliver on further quantitative easing. Also speculation that the Bank of Japan could also sort of focus more on the front end of the curve in its asset purchases, which would sort of steepen that curve as well. So that's what we have seen in world bond markets in the last week or so. Now the oil price lower, again sort of lower today. A little bit of a rebound yesterday, but nothing really to suggest an imminent recovery, and it looks like it's going to be pressuring this September low of $43 on the WTI. So that is certainly another reflection of the disappointing outlook we have on markets today. So what have we got to look forward to today? Well, we've got the US data this afternoon. This is the final real bit of data that we get in front of the Fed. You've got the inflation data. You've got headline inflation on the CPI. Now, it's important to remember also that this CPI data is not data that the Fed sort of takes its inflation readings from. The Fed prefers to look at the PCE, which is the personal consumption expenditure. CPI is not the Fed's focus. So this rise in the CPI headline to 1.0% from 0.8%, and also the core staying at 2.2 is not going to do a great deal. So here we see on the charts nothing really in terms of traction in the last few months. 1% seems to be fairly average, as does 2.2%. So nothing really doing in that inflation data if that hits those levels today. And also the Michigan sentiment at 3 o'clock. It's expected to come in at 90.8, mildly higher than. Actually, this is the flash reading or the preliminary reading from last month. So 89.8 was the final reading. So that would be a point higher than that. But certainly this data out this afternoon is not really going to affect the dollar too much. But that takes me to my chart today, which is the Kiwi dollar. Now, what we have seen is this long-term breakout on Kiwi. Now, if I zoom out, you can see that the extent of this breakout, big move that we saw a couple of weeks ago, retracted back in to this uptrend and has held on to that uptrend and posted a couple of positive candles. So this corrective phase that we've seen has unwound the Kiwi dollar now, and unwound the bullish, overbought momentum back to sort of levels that you see on the RSI where the bulls start to come in around that sort of high 40s, 50s area. Stochastics turning higher, crossing higher. That could be potentially positive if it sort of doesn't sell off dramatically into the close today. And a move back above 73 figure, which is I've been talking about as a bit of a sort of a resistance overhead, which had been sort of in place June, July and August. Breakout in September, but that would again be a positive move if a move above 73 figure can be sustained. But certainly it looks as though at the moment this is sort of a sort of band of support that's beginning to form now around that sort of 72.30, 72.40 area in the last few days, and sort of trying to push out. Move above 73 figure is a positive one, as I said, as there is a sort of pivot band around that. Even on the hourly chart, you can see that there is a sort of a turning point, or several turning points that happen around that 73 figure mark. Back to there now. So will this be the chance to buy? You've got the hourly chart that's just unwinding on the MACD lines, having pushed out into positive territory. Also the RSI having pushed yesterday to the highest level in over a week. So this is all suggests that I think the market is beginning to form this support around 72.40, 72.30. And I think it's building, and I'm not necessarily saying it won't just drop back, may not just sort of continue to consolidate in the meantime. Obviously we've got the Fed, market's going to be cautious, and maybe that will be the case, but certainly there is a support building now at 72.30 that you can build from, holding on to this uptrend, and it certainly looks relatively positive on the charts. So I wish you good luck in your trading today, and I will speak to you later. Thank you.